I'm Howie Lim. This is Money Hacks by the Business Times. As the year draws to a close and we gear up for the festive season, let's figure out how 2025 went for our portfolios and what might be in store in 2026. After all, it's beginning to look a lot like something. Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And joining us today, Charu Chanana from Saxo, Jeremy Hall from Brookfield, and Hugh Chung from Endowus. So how was 2025? And what should we consider in 2026 if we want to focus on real returns and not just nominal gains?
Always good to be here into 2025 with the new administration in the US and obviously a lot of the tariff concerns impacting markets, particularly in April. A lot of people were worried, but it ended up being a pretty good market for risk and equity in particular. So going into next year, I still do think that the global economy is still in decent shape. We're seeing companies, reporting pretty strong earnings. And then this year, another thing that's worth mentioning is that not just the US markets, but Asian markets have done very well. European markets have also done reasonably well. So it's been more broad-based as opposed to just US tech names as well. So to your question on real returns with inflation being sticky, historically, you have to remember that actually stocks have been a pretty good way to beat inflation. And the reason is because stocks represent all the global companies or listed companies' earnings and also revenue, which is on a nominal basis, meaning that if inflation goes high, a lot of companies are able to pass through that. So historically, global equities have given you, let's say, 7 to 8%. Inflation has been 2 to 3%. I don't think this changes the landscape of us trying to drastically change our portfolio going into 2026.
Thank you for having me, Howie. That's a wonderful question. It is certainly a concern, even though we've seen that inflation is cooling, but it is still quite sticky. And with rate cuts coming, the biggest shift in 2026 in terms of those real returns that you mentioned will be that the cash stops paying you, or at least it pays you less. So I think that is something obviously very, very important for investors to understand, that if they've obviously parked their cash in instruments where the yields are starting to go down, then how do they position it to be able to get the returns that really beat inflation? From that perspective, investors really need to think about assets that can grow, assets that have a lot of pricing power because you still need to tackle that inflation problem, and assets that also give you income, especially if you are an income-oriented investor, assets that give you income that adjusts to inflation. That does mean, I think, for investors who are willing to take risks, that does mean more equity, especially still being inclined towards sectors that have strong earnings or even sectors that are maybe tied to structural demand.
That was Charu Chanana, Chief Investment Strategist from Saxo. And also we heard from Hugh Chung, Chief Investment Officer from Endowus. And both seem pretty sure about what to do for 2026. Now, Jeremy Hall is head of international for Brookfield's private wealth business, Brookfield Oaktree Wealth Solutions. He feels investors will be confronted with elevated valuations in traditional public markets.
Real assets and private alternatives offer the benefit of inflation-linked cash flows, income stability, and diversification in ways traditional equities and bonds often cannot. Appetite for investing in alternatives among investors in Asia is strong. In our recent Brookfield Alts Institute survey, we noted in those results that 80% of existing investors in alternatives intend to increase their allocations if they understood alternatives better, and 83% of investors who currently don't invest in alternatives would also start to invest in alternatives if they better understood alternatives. In an investing environment where public markets do fluctuate and macro debates persist, adding high-quality alternatives to help build more resilient, better balanced portfolios for 2026 and beyond, we believe makes sense.
For much of 2025, private markets investing has dominated discussions within the private wealth industry and among regulators. Private markets are evolving quickly. Endowus' Hugh Chung is happy that retail investors are having access to this asset class, which is essentially 70% of the corporate world.
the most important thing that investors or people hearing this should think about when you're investing in private markets is really concentration of liquidity. What I mean by that is if you own one private company, you're at the mercy of that company. And if it doesn't do well, then you won't get any money back. Vice versa, if it does well, obviously it'll do well. If you have exposure to thousands of private companies that are globally diversified around the world by sectors, etc., you're basically having access to that asset class. And even though they are illiquid, the risk of permanent capital loss is very little, right? So I think that is very important. You need to focus on liquidity. You need to understand that these are private companies. They are basically illiquid, but you're getting compensated through higher returns and a diversified or differentiated investment destination that's not part of public markets. So I think the important thing is to understand that it is an illiquid asset class.
I would treat private markets as a complement. It cannot substitute really my public markets portfolio, but it adds a nice complement to it. Certainly worth considering, but risk tolerance decides what percentage you allocate to that. The other important point to understand is the fees that even though retail investors can now access these private market opportunities, I think looking at fee structures, understanding it well is very, very important because a lot of these retail access private funds, they still charge fees like hedge funds do. And fees is one of the biggest factors. And that's why active investing has not been so successful for so long because the fees really eat up into your long-term returns. We need to be conscious about how much are we paying for it and what is the after fee returns that we are making.
Okay, words of warning from Charu and Hugh, but Jeremy from Brookfield is still bullish on private markets.
We are seeing improving financing conditions, and we believe the real estate asset class is set to benefit from both a cyclical recovery and strong structural tailwinds. As it relates to private credit offers floating rate income that resets higher as rates rise and low duration in terms of its exposure, which provides greater resilience in interest rate volatile environment. Many private credit strategies such as direct lending and asset-based finance are supported by real and growing cash-generating assets. For example, royalty streams or aircraft leasing or loan pools, meaning performance depends more on the asset fundamentals than on macroeconomic conditions. So our view would be investors could perhaps gain exposure to all three of those asset classes or perhaps dip their toe in the water with any one of those asset classes.
Still to come. What does 2026 have in store for retail investors? And what can we look into for the best long-term risk reward? More with our experts in a moment.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Claressa Monteiro in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Money Hacks from the Business Times.
Welcome back. No one can deny it was a chaotic year for stock markets. Not to say it was all bad, as Hugh Chung from Endowus mentioned earlier, especially for AI and tech. But 2026 could be better?
Yeah, so I think there's been a lot of concern that's been coming out recently on what we call an AI bubble. It's been on the back of a lot of the hyperscalers spending a lot of money on CapEx, and we haven't really seen the revenue generation from those CapEx, so people are worried. But I do think that there are a few distinct differences this time versus like the tech bubble of sorts. First of all, the big companies are still generating a lot of cash flow. Although there's some debt financing going on, a lot of it is really invested through cash flow, and they are reporting very, very strong numbers. If you look at valuations, they're high for sure. But compared to the growth and compared to what valuations used to be during the dot-com, it's actually much more reasonable. So it's important to look at how the AI spending and all of that is impacting not just the tech companies, but the overall productivity of the market. And when everyone is worried about a bubble, it's normally not a bubble. It's definitely worth watching. From our perspective, the way to prepare for this is to have diversification in your portfolios. Doesn't mean you take out the core investments of AI and technology because it is a very, very critical part of your investment.
What is different going into 2026 is the concentration risk. So for those retirees who've invested their retirement funds in, say, a US index or even an MSCI World for years, that might have worked for them. But because of this AI theme, the concentration has gone up in these broader indices for these AI stocks also significantly. So if you are invested passively in an index, you could still be exposed to a lot of tech volatility. That is, I think, something which is different in the recent years and something very, very important to understand, that you need to make a conscious choice of balancing out your tech exposure. Maybe adding even different sectors for balance, like healthcare, which is more defensive. So just being in a broad index is not enough. For younger investors, if they are willing to take even more risk, again, if they have this belief that AI is going to continue to drive a lot of changes and is the bigger driver of the economy going forward, they could tilt their portfolios more towards those thematic and structural plays. And the younger investors also have time to kind of dollar cost average to smooth out the volatility. So they could take advantage of the dips that come through because of a more volatile year that 2026 could be. So keep adding, and dollar cost averaging gives you the benefit of adding both when the market goes up, but also when the market goes down. So it brings down your average costs.
While it's comforting to know we could still include the largest concentration in the US indices in our portfolios, diversification is key. And you can even do that within the AI space. Here's Charu again from Saxo.
When we are looking at it from a long-term growth perspective, we obviously have to take a step back and move away a little bit from those hype stories and really look for policy-backed trends. Where is the capital moving towards? I can't move away from AI. Within AI, because the volatility is going up, we are talking about concerns around AI bubbles. There are pockets of froth in the AI story. So where is that policy-backed trend within AI is potentially in that energy infrastructure. We know that the data centers need immense amounts of power. So we need grid upgrades, we need renewables, some form of nuclear to really satisfy that grid constraint for that AI theme to continue to be a long-term story. Power generation and grid upgrade stories.
In the name of diversification, what's looking good for 2026 and the best for long-term risk reward?
I do think that healthcare and biotech are also long-term compounders that have recently started to perform, actually, because they were a little bit hidden from the technology limelight, so to speak. But they are kind of secular growth areas where they're seeing innovation. Healthcare is also generally considered more defensive, given it is a necessity. Those are sectors that are worth, looking into, particularly for those sectors. There's generally tends to be better, what we call alpha opportunities. So active managers tend to pick the winners and the losers. The other area that I would recommend to watch is really the Asian market. Asian markets have been very strong, particularly the North Asian markets. So China, Korea, Japan, Taiwan as well. Singapore home market has been very, very strong as well. And before, if you look at Korea and Japan in particular, they were really like a one-trick pony, basically follows a global cyclical cycle because there's a lot of exporters that are following that cycle. More recently, it's been a lot more driven by improvements in corporate governance, increase in dividends, so what we call the value up program. So I do think that the Asian markets provide a very good diversification destination from the US. And yes, it's done well the last year or so, but as an area, that's something worth watching. In Singapore, the MAS has actually been advocating equity development program to improve the liquidity and transparency and valuation of the home market. And I think that's also worth watching as well.
Firstly, we'd say private markets are not one size fits all. Different asset classes play a different role in a portfolio, and investors vary widely in terms of their goals, time horizons, risk profiles, and liquidity needs. So really understanding these differences helps investors to align their exposure in alternatives and what they want to achieve. For example, infrastructure and private credit can provide income and stability, while private equity tends to offer higher growth and diversification. And this all highlights the importance in education. We would look at manager selection as being critical, look for an experienced team with a strong track record and clean, aligned incentives.
And what else should retail investors look out for by way of macroeconomics? Will it be Fed rate cuts, geopolitical tensions, interest rates, or all of the above, pulsed in a blender to a frothy mess? Okay, breathe.
Yeah, I think it's important to understand that AI is currently not allowed to give recommendations or financial advice just from a regulatory perspective. AI is obviously a very powerful tool to go through large amounts of information. It's really about efficiency. It's really about sifting through the noise and giving you the information you need. But the actual recommendation, at least in the current financial framework, is for licensed people to actually go through that process. So I don't know what all the AI digital players are out there, but I'm pretty sure they're not allowed to give a purely AI-based recommendation. So as an individual, you should use that to process information. And then there's a lot of very interesting tools out there to do that. But we're never a believer of what we call robo-advice. At Endowus, it's all about human advice and deep finance. Because a lot of times what robo-advice can mean, robotic advice, systematic advice, etc., which you're essentially competing with the largest quant funds out there, which spend billions of dollars in R&D. And I think that's just not a very good way. So as an individual, when we make decisions, it should be human-led and it should be based on, again, your goal and your work backwards. So just because an AI tool said so doesn't mean it's the truth.
Investors still need to temper their return expectations from here. And what this really means is we wouldn't get the same kind of easy gains that we had post-pandemic. Probably it could be a bit better for investors to be more active in terms of their investing, whether it's stock picking or what kind of sector tilts their portfolios have, that matters a lot more. Gone are the days when that passive investing can continue to work because your risk exposures are also very, very concentrated. It is a time when active investing could really make a comeback.
Money Hacks Takeaway Order 250 is ready. In 2026, forget the free money market. Real returns are the VIP section and nominal gains are just the bouncers. Equities are still a decent inflation shield, but since cash yields are headed south, your lazy money needs a new gig. Diversification is your Swiss Army knife. Think global. Hello, Asia and healthcare biotech. And niche. AI needs more than just brains. It needs power, so look at energy infrastructure. Private alternatives are the fancy financial gym with inflation-linked weights, but watch out for the 3 LFCs: liquidity, fees, and concentration. A big thank you to our experts, Charu Chanana, Chief Investment Strategist from Saxo, Hugh Chung, Chief Investment Officer from Endowus, and Jeremy Hall, Head of International for Brookfield's private wealth business, Brookfield Oaktree Wealth Solutions. And Money Hacks takes a break on the 29th of December. We'll catch you in the brand spanking new year, 5th of January, 2026. This has been Money Hacks by the Business Times. I'm Howie Lim. Happy holidays, everyone.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.